First of all, let's talk about what I'm going to talk about. I'm going to talk about a longer-term perspective on gold supply and demand. I'll talk about how much gold is to mine and what the trends are in recycling of gold rather than presentations as well. Because it's such an important issue, I will talk about ESG and gold, both gold mining but also gold the metal. And then we'll have a look at the impact of recent crises on gold, but also gold over the longer term in terms of investments. And I'll conclude with an outlook. First of all, who are the World Gold Council? We're an industry organization that started about 30 years ago. We represent the major gold mining companies around the world, and we're here to develop the gold market, basically to encourage ownership of gold and to increase accessibility to it. We've done a lot of things over the years. I've listed some of them on the right-hand side. We came up with the idea of gold-backed exchange-traded funds, for example. We've worked in China and India a lot as well. What we primarily do is provide data and research and commentary, market knowledge on the gold market. And I'm a chief market strategist here. We also work with governments to allow more accessibility to the gold market and also to open it up to investors in many cases. And where necessary, we'll get involved with infrastructure projects such as exchanges. Next slide, please. So let's talk about supply and demand. I think the first thing to remember with gold is we're talking about an unusual instrument. It's often lumped together with commodities, and it certainly does have some commodity-like characteristics. But the difference between gold and other commodities is that when you mine gold and refine it and turn it into a product, it never really goes away. It's not like crude oil, which you burn, or wheat, which gets eaten. All the gold that's ever been mined is available to the market in one form or another. And through antiquity, it's estimated that about 197,000 tons of gold has been produced in history. Most of this has gone into, or a majority of this has gone into fabrication, into jewelry, or into other industrial applications. Investments, a decent chunk of it, as you can see on the second chart there, a mixture of bars and coins owned by individuals, the official sector, typical central bank holdings, and increasingly now into exchange-traded funds. It's a big financial market. It's a large liquid market as well. So even though annual production is only about 3,400 tons a year, the stock of gold, 197,000 tons of gold exists, is available to the market under many conditions. So let's talk a little bit about supply and demand. And the first thing I'm showing here in the chart is how total gold supply and total gold demand has grown over the last 40 years. This is a market which has seen increases in both production and recycling over the long term. The increases we've seen haven't been even. You'll note a period between about 1999 and 2009 where total supply and demand for the gold market was static. And I'll talk a little bit about that when we talk about mine supply later. But in generally speaking, more gold is produced, more gold is consumed each year over the last 4 decades. Although there are arguments that that may be coming to an end, which I'll discuss later. Where that gold demand goes has changed a lot over the last 40 years. Generally speaking, what you can see over the past 30 years, there has been first of all, a large increase in that red segment, and that red segment is jewelry demand. So that's increased from about 40% of demand up to virtually 100% of demand back in 2001, 2002. And then we saw a sharp decline in the contribution that this segment of jewelry has made since then. So what's been going on? Well, a couple of things. First of all, we think about where the gold market was back in 2001. That's when we were at recent multi-decade lows in price of around $250 an ounce. The investment component of the market was very small. Central banks were actually selling, which is why that chart adds up to more than 100%. So we were in a negative environment for gold. Prices were depressed. Price elastic demand, primarily for jewelry, was very high, and investors couldn't really care less about it. What we've seen since then, since this low point in 2001, we've seen the gold price move from $252 an ounce at its low up to recent highs above $2,000 an ounce. Now, there's been two big events that have really driven the increase in investment demand. One of those was in the run-up to the global financial crisis, when you can see those blue bars getting bigger and bigger. And then the second one has been, obviously, in the last couple of years, as gold has started to move higher again, initially because of monetary policy actions, primarily by the Federal Reserve, and then, of course, the increases that we've seen in 2020, driven by the coronavirus. So we've gone from a market that was driven by jewelry demand, dominated the makeup of demand, to one now which is much more balanced. I think the other thing I'd point out as well is that central banks, which were selling gold pretty steadily in the 2 decades up to the global financial crisis, have turned net buyers now as well. That's been another big change in the market. One of the points I like to make about gold is that it really is an emerging market story. So this is consumer and investment demand for gold. I've excluded central banks from this argument to show that really over the last 25 years, we've seen solid demand component from emerging markets. It probably averages at about 75% over this period. And in fact, in 2013, when the gold price was correcting from its prior all-time highs and Western investors were selling it, emerging market demand was more than 100% of the market. So that's an important thing to understand. Yes, the activities of investors and speculators and Western jewelry demand is important, but it's overshadowed by the demand that comes from emerging markets. Now, we've done quite a lot of work looking at the drivers of gold demand, and it's something that fits into and feeds into our gold valuation framework that I'll be talking about later. But the work that we've done effectively brings down the drivers of gold demand into 4 reasons, and they're not all aligned. In fact, sometimes they're contradictory. The first is economic expansion. Consumer demand is very much driven by growth in wealth and growth in income, particularly from the emerging markets. But on the other hand, risk and uncertainty, almost the opposite of positive economic growth, is a big driver of investment demand as well. Opportunity costs, in other words, interest rates, plays a big component, as does momentum, although these are more tactical elements. So the strategic drivers of gold demand very much coming from economic expansion, along with risk and uncertainty, tactical, opportunity costs. So let's talk a bit about mine production in more detail. First of all, if you look at new mine supply plus the recycling primarily of old jewelry demand, you'll see the picture that shows this growth pattern for over the last 40 years. And what you can see is that gold mine supply is driven because prices have gone higher, and recycling has increased because prices have gone higher as well. But they work on slightly different time frames. If the gold price goes up now, gold mines aren't really in a position to increase their production. They usually operate their mines at pretty much 100% capacity, even more if they can. And just because the price is a couple of $100 higher doesn't mean that they can suddenly produce more gold. What it does mean is that they can do more exploration, more project development, and maybe extend the lives of some mines. So typically, high gold prices mean more gold production in the future. And that's one of the reasons why we are seeing gold production increasing from about 2009 onwards up until now. And that's a reflection of the fact that after being at $250 an ounce back in 2001, gold reached highs above $1,900 an ounce by 2011. So that increase in price led to increases in new mines, which then reflected thereafter. Where we are at the moment, there are indications that gold supply may be topping out. There's a lot of people talking about peak gold production. And the reason they're talking about it is that a lot of mines that should be under development haven't been done so because of the decline in the price we saw in 2013, 2014. So it's going to be difficult for the mining industry to sustain the levels of gold production going forward. A lot of people are expecting slow and steady declines going forward. Recycling, however, will make up much of that deficiency, and depending how high the price will go, recycling can react quickly. There's a big stock of old jewellery in the world, and higher prices, particularly combined with economic hardship, tends to tempt us out. So how much gold is there left to be mined? Well, the USGS, US Geological Services, estimate 50,000 tonnes, so about 16 years of gold production at current levels. But that's not a real number. What we find is that new discoveries are being made all the time. New mines will be brought on stream that aren't even part of that 50,000 tonnes. So I'd expect gold production to continue virtually indefinitely. I just don't think they'll be able to bring on new mines quick enough to make up for the ones that will be closing perhaps in the next few years. So let's talk about ESG. It's an important component of our conversations now, and something that we weren't spending a lot of time on more than about 3 years ago. But we've recognized that gold mining, along with every other economic activity in the world, has to justify itself in terms of its impact on society. We produced the Responsible Gold Mining Principles about 18 months ago, which are 10 areas which I've shown here, anything from supply chain integrity to make sure that gold is being sourced ethically, labor rights, in other words, supporting the legitimate ambitions of the workforce to be represented. Water, energy and climate change, obviously clearly very important issues, both globally but also specifically to the mining industry, because if you don't have the support of the local population, particularly regarding water use, you're going to find it very difficult to get permission to build a new mine. So this is an overarching ESG framework. It has been embraced by all of the members of the World Gold Council, and they are committed to its full implementation by September 2022. That's not to say that they're not doing all these things already. It's just that in order to comply with the RGMPs, they need to externally validate everything that they are doing. And that's why they had a 3-year introductory period. It's not to change their behavior as much as to make sure that it is properly documented by a third party so that we can stand up to it. Now, the RGMPs are being adopted by our membership, but other mining companies who are not members yet of the World Gold Council have also shown a lot of interest in doing so. The gold industry recognizes that it needs to demonstrate that it is a responsible player in the global economy. From another perspective, we've done quite a bit of work looking at gold from an ESG portfolio perspective, principally looking at gold's contribution to climate change emissions. So one of the things that we are looking at is not gold mining per se, I'll touch on that in a moment, but actually on owning gold as an investment. Because about 98% of the emissions involved in gold as an investment are incurred during production. Once gold has been turned into a bar, once the 197,000 tons of gold in all its different forms are around the world, its ESG impact or its climate change impact thereafter is minimal. So if you work on the basis that you're buying gold that has already incurred its climate change emissions, then it actually is a low climate change asset and can arguably lower the carbon footprint of an investment portfolio over time. I've mentioned the mechanisms to validate responsible gold production, which fits very much into the RGMPs. We're also doing work regarding making sure that the gold industry fits into the United Nations Sustainable Development Goals. And we published a report on that a few weeks ago. Okay, now gold, I'm saying actually it's not just for crises. So let's explain why. If you go back to the drivers of gold demand slide I had before, it shows how these drivers actually assist gold during a crisis. If you look at them, okay, economic expansion certainly isn't a positive during crises, but risk and uncertainty, low interest rates for opportunity cost, and the momentum for an investor buying of gold contributes to gold performing very well during crises. And the recent crises, the GFC and then now the coronavirus crisis, seem to have shifted this contribution to gold demand, increasing the component that investment plays to it. And certainly on the basis of the GFC, that looks like a near permanent shift. Maybe we'll see the same thing with coronavirus. But gold's not just for crises. We have 3 principal arguments why gold is an investment that everybody should have in their portfolio. First, looking at this one, this is showing the year-to-date performance of gold in 2020 for the first half of the year, showing it was the best performing asset class. Looking over the longer term, Gold has been a source of return for portfolios, not just during crises, but over the longer term. So since 1971, at the end of the gold standard, gold's average annual returns of around 10 and a bit percent have stood up very well to other assets. Over the last 20 years, it beats everything, apart from emerging market stocks. Over the last 10 years, has been a bit overshadowed by US equities, but then potentially there's an argument for mean reversion to play there as well. It's also a great asset for diversification. In general, gold is uncorrelated to equities and other instruments that have equity-like return characteristics. But if you look at what happens when equity markets fall sharply, so when the S&P 500 is down by more than 2 standard deviations in a week, you'll see gold's correlation flips negative. So you're negatively correlated to a rapidly declining asset. That's really useful and provides a lot of protection to portfolios. Next slide shows what difference that has made over the last 10 years. On a hypothetical portfolio which mimics a US pension fund, adding gold to a portfolio increases the risk-adjusted return of that portfolio. And generally speaking, within this range, the more gold you put in, the better the risk-adjusted returns. And the sweet spot somewhere between 5 and 10% in most portfolios. The outlook for gold is probably going to be covered more by Jim than me, but I would direct you to something that we put out in the middle of the year, which is the investment drivers that we see keeping investment demand strong for gold over the next few years. Again, comes back to those 4 drivers of gold. And obviously the economic recovery will have a big impact upon that. Very much debate at the moment, is it V, is it W, K-shaped, etc. You can experiment and investigate what the outlook for gold demand might be by going to our website, gold.org, and looking at the valuation framework tool that we have, which allows you to put in economic forecasts and see what will happen to gold demand under various circumstances and then generate returns. I would encourage you to go to Gold Hub, which is our resource of data, research, and tools. It's free, just requires registration. Great source of information for the gold market. Thank you.